Stock market. You must have already heard this term before in your school days. It's like a swap meet, an auction house, and a shopping mall all rolled over into one. Its functionality is so complex that people with years of experience struggle to understand its dynamics. But how did this market evolve to such complexity over the centuries? Let's find out and dive into the history. Well, let's rewind our clock to the early 1300s in Italy, in Venice city. The city is also known for its canals. It was a home to some savvy financial minds. The Venetian moneylenders were like Wall Street traders of their own time. But it was not stock that they were trading, it was debt. Yes, you heard it right. That means they used to carry information manually on the slates or other mediums. So if they find out that one of their loan is actually risky, they would try to trade it with another loan in the market. It's like saying, hey, I will take your loan if you take my risky loan. And if they both traders agree, that's a deal. So Venetian moneylenders were actually leaders in their field, and that's how they democratize finance. So let's talk about the first exchange. It started in 1300s, during which Low Countries like Belgium, Netherlands and Luxembourg were sandwiched between two trading giants, the Italian republics to the south and the German Hanseatic League to the northeast. The ports of Antwerp and Bruges quickly emerged as one of the important commercial hubs for international explorers and merchants. The Venetian used to transport precious gems from the Far East. On the other hand, Germans shipped in furs from Russia. Innkeepers in Antwerp and Bruges would not only provide a roof over the heads of the travelers, but would also help them exchange their goods. By granting information and international arrivals, the local were able to announce exchange rates from various banking hubs of the Europe, including Paris, Venice, and London. One of the most important innkeeping trading families were Van der Beurs. Therefore, it is said that the pivotal role played by the Van der Beurs in brokering these early economic trades led to the creation of the word Bourse or Bourse, in French meaning stock market. Some historians argue whether it was Antwerp or Bruges where the trading markets first originated. Most agree that it is the Handelsburg in Antwerp that was the first ever specifically dedicated stock exchange building. Built in 1531, Handelsbeurs was home to city's Chamber of Commerce for almost 500 years. By the early 16th century, merchants were trading less often in real goods and more in notes containing promises from one person to lend money to another. In 1997, this stock exchange was merged into Brussels Stock Exchange, which is presently known as Euronext, and the building was once again more abandoned and neglected. Following the extensive restoration, the building is now the part of multi-purpose events venue known as Antwerp's Trade Fair. Back in 1600s, a group of British merchants set up a new trading company that would change the world. That is East India Company. Their goals? To trade with the East Indies, that is modern-day India and Southeast Asia. Now, this was not your average company. It quickly became one of the most powerful trading entities ever. But here is what it gets interesting. You see, voyages to the east were extremely expensive and very risky. We are talking about the long journeys across the dangerous seas with no guarantee of success. So, instead of taking all the financial risk themselves, East India Company came up with a brilliant idea. They decided to sell shares of their voyages. This meant that multiple investors could put in some money and share in the profits or losses for each voyage. This way, they could raise huge amount of money without any single investor bearing all the risk. This concept of pooling money and spreading the risk was revolutionary. Now let's fast forward a bit. As the East India Company grew, their shares became more popular. Investors began buying and selling them not just to participate in voyages, but to make money from the company's success. But where did this trading happen? Well, not in fancy offices. These transactions took place in London's coffee houses. One of the coffee house in particular, Jonathan Coffee House, became so popular for trading shares that it eventually turned into what we know today as the London Stock Exchange. So, why is this important? Well, East India's company's approach was one of the first examples of issuing shares that could be traded. It showed the world how companies could raise capital by inviting the public to invest, and it introduced the concept of limited liability. That means if you invested in a company, the most you could lose was your initial investment. You would not be on the hook for the company's debts. The origins of the London Stock Exchange can be traced back to the 17th century. At this time, there was no formal stock exchange, and trading was rather a chaotic activity. Merchants and brokers would gather in various coffee houses around London to conduct business. Among these, Jonathan's Coffee House on Change Alley became particularly famous. It was here that a man named John Casting began listing in stocks and commodity prices in 1698. This simple act was beginning of what we would eventually evolve into the London Stock Exchange. By the late 18th century, the need for the more organized and regulated marketplace became evident. As trade grew, so did the need for structure. In 1801, the London Stock Exchange was officially established, becoming the first regulated exchange in London. This move marked the transition from the informal gathering in coffee houses to a structured financial institution where rules and regulations governed trading. The 19th century was a significant period for London Stock Exchange. The Industrial Revolution was in full swing, and this brought a surge in companies seeking to raise capital. The London Stock Exchange became the go-to place for businesses to access funds, and as a result, it expanded rapidly. By the mid-19th century, the London Stock Exchange was already one of the largest stock exchanges in the world, with hundreds of companies listed. This period also saw a development of formal trading practices, including the introduction of specialized brokers and jobbers. Despite its growth, London Stock Exchange faced many challenges, especially in 20th century. After World War I, London's dominance in the financial world began to wane, and New York started to emerge as a major competitor. However, the London Stock Exchange remained resilient and adapted to changing environment. It introduced new technologies and practices which helped maintain its status as a key financial sector. One of the most significant moments in the history of London Stock Exchange was the Big Bang in 1986. This was a series of financial deregulations that transformed the way exchange operated. The Big Bang marked the end of the traditional face-to-face trading and introduced electronic trading system, allowing trades to be executed more quickly and efficiently. It also opened the market to international players and brought in more competition. This modernization greatly increased the volume of trading and helped re-establish London as a leading global financial hub. In the 21st century, the London Stock Exchange continued to evolve. In 2007, it merged with Borsa Italiana, the Italian stock exchange, creating a more diversified and powerful group. This move expanded the London Stock Exchange's reach and solidified its position as one of the largest stock exchanges in Europe. Over the years, the London Stock Exchange has continued to adapt to the changing financial landscape, introducing new technology and trading platforms to stay competitive in a digital age. Today, the London Stock Exchange is one of the largest and most important exchanges in the world, with the listing of thousands of companies from over 60 countries. It serves as a barometer for the global economy, and its FTSE 100 index is widely regarded as one of the leading stock market indices. The London Stock Exchange continues to innovate, offering a range of services from equity and debt trading to derivatives and data services, cementing its role as a critical player in the global finance. The story of New York Stock Exchange began in 1792. Right there on the Wall Street. It all started when 24 brokers and merchants signed what is known as Bretton Woods Agreement. This simple two-sentence document established the rules for buying and selling securities and laid the foundation of what would eventually become the New York Stock Exchange. The brokers agreed to trade only with each other and to charge a fixed commission rate. They met under a buttonwood tree, hence the name, until they eventually moved indoor to the Tontine Coffee House in 1793. The New York Stock Exchange grew rapidly over the years. In 1817, it adopted its official name, New York Stock and Exchange Board. The exchange began to formalize its operations and creating more rules and regulations to ensure fair trade practices. As America industrialized in the 19th century, the New York Stock Exchange expanded alongside it. It became the place where countries' biggest companies went to raise capital. And by the late 1800s, the New York Stock Exchange had moved its current location to the Broad Street. Throughout its history, the New York Stock Exchange has gone through multiple booms and busts. One of the most famous was the Panic of 1907, which saw the market drop nearly 50%. This crisis led to the creation of the Federal Reserves in 1913, which now plays a crucial role in stabilizing the economy. The 1920s brought the roaring 20s and a massive stock market boom, but it all came crashing down in 1929 with the infamous Wall Street crash, leading to the Great Depression. This event forced the government to implement major financial regulations such as Securities Act of 1933 and the Securities Exchange Act of 1934 to prevent future collapses. The New York Stock Exchange continued to grow in 20th and 21st century. It went through several technological changes like the introduction of the electronic trading system in the 1970s and 1980s, which transformed the way trades were executed. Today, the New York Stock Exchange is a symbol of capitalism and global finance. It handles billions of shares every day, and the companies listed on the New York Stock Exchange represent some of the largest and most influential in the world. India's financial system is one of the most dynamic systems in the world, with its two major stock exchanges leading the way, National Stock Exchange and Bombay Stock Exchange. Our journey begins with the Bombay Stock Exchange, popularly known as BSE. It holds the title of Asia's oldest stock exchange, with a history dating back to 1875. The story starts under a banyan tree on Dalal Street in Mumbai, where a group of 22 stockbrokers would gather to trade shares. This informal setup laid the foundation for what would eventually become the BSE. It was not until 1957 the BSE was officially recognized by the Indian government under the Security Contracts and Regulation Act, making the first stock exchange in the country to be recognized. As the time progressed, BSE became synonymous with the India's financial growth and industrial expansion. The exchange continued to modernize, introducing electronic trading in 1995, which replaced the traditional open outcry system. The BSE also launched the Sensex and its benchmark indexes in 1986, which became the pulse of India's stock market. Today, it stands as one of the fastest stock exchanges in the world, with the trading speed of 6 microseconds. While the BSE was pioneer, it was not the only player for so long. In 1992, a game changer emerged on the scene, the National Stock Exchange, or NSE. Established with a vision to bring greater transparency, efficiency, and technology to India's financial markets, the NSE quickly became a mark. Unlike BSE's beginning, NSE was designed from the start to be a fully electronic platform. It introduced a national-wide screen-based trading system, which was a revolutionary step for the Indian stock market. This allowed investors from all corners of the country to participate in trading, breaking the geographical limitations of earlier systems. In 1996, the NSE launched the Nifty 50, its benchmark index which represents the top 50 companies listed on the exchange. The Nifty 50 quickly became one of the most widely followed stock market indices in India, just like the Sensex for the BSE. And there you have it, the stock exchange's epic journey. From the Venetian merchants haggling over bills of exchange to today's interconnected digital networks, it's a saga of ambition, risk, and resilience.